All right, guys, welcome back to another video. And in this one, we are going to be going over my exact options trading strategy that nets me about 3 to 5% per month on my live account. Now, this is a strategy that I've been trading for about 2 years now that generated me about 80% last year. And we are on track to hit another 35 to 40% this year, depending on how the rest of the year goes. So what we're going to be doing here is taking a look from a chart perspective, and we're going to be looking at the options chain. This is going to be a complete rundown, start to finish, no clickbait, of my exact strategy that I use. So if you're new here, this is exactly what you're looking for. This is the exact strategy that I use every single week. If you're returning, this will be a good refresher video for you, or maybe you've missed something. So definitely stick to the end because I have a lot of cool little tricks that I use for my option selling specifically. So we'll be taking a look at it from the chart, like I said, and we're going to go over to the options chain and actually show you guys how you can place an order and whatnot. So jumping straight into this, the first thing I need you guys to do here is extremely important. You need to be doing this on stocks that you believe in long term. So in this example, I'm going to be using Rocket Lab. This is just going to be like, for the use case example. This is a position that I am looking to start building in. I kind of like Rocket Lab a little bit more after, reading about their earnings release that just came out the other day. So definitely a stock I'm interested in. But for you guys, this strategy only works if you are doing this on stocks that you genuinely want to own long term. No strategy is going to save you from a bad stock pick. If you are in a stock just because the premiums looked good, you are probably going to get cooked. If you have not done your due diligence, you're probably going to exit your trades early. It just never ends well when you don't pick solid stocks. So one of the biggest things here is your stock selection. These stocks have to be obviously quality names that are going to be around the next 10 years. And obviously I don't really go too much into fundamentals specifically, just because how I interpret fundamentals is not how you are going to interpret them. So please do your own research, do this on stocks you like. Nothing I teach here is financial advice, but this is just the example I'm going to be giving you. I want to give you guys like a vehicle of how to assess the market from a technical perspective. Just do your own fundamental research. And I have to stress that so much before I get into the strategy. But jumping straight into this, once you have found a stock that you like, the first thing you're going to do is obviously, look, I like this stock, I want to own it long term at these levels. So jumping into a technical perspective, I'm on the 4-hour time frame. And the first thing I'm going to do here is check where this stock's all-time highs were. So this is obviously assuming that the fundamentals are rock solid on the stock. You want to own it long term. So in Rocket Lab's case, we have 156 being at our all-time highs. And what we're looking for here is being at least 10 to 15% off all-time highs. Because if we're trading next to all-time highs, I do not want any part in that, just because if we're really close to all-time highs, there's still a lot of room down that we could come before continuing back up. And this is exactly the case with Rocket Lab as well, as you can see. If we were 10 to 15% off all-time highs, or if you were even assigned at these levels, so say you caught it at a 10% discount right here, all the way to the lows is about 63%. So you're probably 53% in drawdown from where you bought it to this point right here. So this is why I always say you got to do this on stocks that you actually like owning and you want to own for the long term. So I will say 10 to 15% off all-time highs is your biggest op in this, just because you don't want to catch a stock right at the top. So it has to be at least 10 to 15% off all-time highs. That is step one. So in the case of Rocket Lab, if we're using these levels right here, we can see that we are very much off all-time highs. So very happy with that, about 48% to current price. So in this case, that fits the bill. So 10 to 15% is my rule of thumb. Next, from the most recent high, we have to be at least 5 to 10% off the most recent high. And in this case, so I use a pivot highs and low indicator. It is free on TradingView. And you can see that the only indicators I have on my TradingView are support and resistance levels, as you can see, the 200-day SMA, and pivot highs and lows, just to visually see where a high and low is and at what price it is at. So like I said, 5 to 10% off the most recent high. As you can see from this recent high right here, 5 to 10% is actually a lot of movement. So this is something to take into account. So with a higher IV name, implied volatility. So basically saying with a stock that can move a lot faster and quicker, you can up that 5 to 10% to maybe 10 to 15%. And this 10 to 15% rule for all-time highs can be up to like 15 to 25% as well. So in this case, this still fits the bill. And where we want our strike price is usually at an area of support or between two levels of support. So in this case, I see a level of support right here at 75 and another one here at 60. So what we're gonna do, before we even look at this options chain, we are completely going to go and check our levels, make sure everything makes sense from a technical perspective. Options premium is the thing we care about last. So in the case of Rocket Lab, I have identified 2 levels of support. Do I want to own at this level? Do I want to own at this level? Or something that I do, very frequently is when the levels are very far apart, I like to buy or sell an option in between them, because if we were to come down, we could bounce off this area. And on the alternatively, if we don't bounce off the area, we slice through it, we get assigned around this area. It still has to come down all the way from here back to our strike. And then we have an area here where we could bounce off as well. So it's very important to pick your entries, specifically with areas of support, just because if there's nothing below us, what's stopping us from absolutely free falling? So you want to see good levels of support. Those have to be tested a good amount. You can see this support level in particular has been tested here, here, here. Obviously this used to be resistance, now turned into support. Again, here. So you can see this is a very good level of support on Rocket Lab, in my opinion. So that's something you do want to make sure. You want to make sure this support level is rock solid. So in the case of Rocket Lab, in this case, like I said, 10 to 15% off all-time highs, 5 to 10% off the most recent high, tapping into a level of support. Now, in a case like this, where do I want to own this at? For this use case example, we're going to be using the support level, which is at about $76. So once I've identified, my 5 to 10 or 10 to 15% all-time high rule, my 5 to 10% off the most recent high, and I've confirmed using the 200-day SMA, what do I do with this? Because this isn't something that is a deal breaker for me, but it is definitely something that plays a big role in my trading setup. So this is the 200-day SMA, the 200-day standard moving average. And what you want to see is if we are trading below this, this is basically us saying, hey, that long-term bullish trend that we had is no longer intact. We're trading below it right now. So anything below this level, it's not exactly okay, you know what, this trade is invalidated, we can't take it. This is just saying anything below this level needs to have some sort of higher conviction from the fundamentals. So there has to be something in the fundamentals that tells you, yes, we could continue back up, break that 200-day SMA and keep going. Alternatively, if we are trading above it, that is an extra layer of confirmation for me to say, you know what, we are still trading above it. That 200-day SMA, broader bullish, higher time frame, bullish bias is still intact. Wow, the word really lost me there. The overall higher time frame bullish bias is still intact if we are trading above it. So again, I use this as confirmation. If we're below it, I need some sort of higher conviction in the fundamentals. If we are above it, this is just an extra layer of confluence for me to take this position. So in the case of Rocket Lab in particular, and the goal for me really isn't to not get assigned shares. I'm never scared of assignment. If I'm getting assigned shares, it's genuinely because I wanted to own it at that level. So in this case, I'm looking for an area where I would want to own the shares at. So for this example, we're going to be using the $76 level. And we're going to look at the 2 possibilities. So when we set a strike price, so what I'm going to do here is I'm going to add in right here, that's 76. Let me get that as close as I can. So that's pretty much as close as it's going to get. So I'll put a cash secured put right here. So this is the level where I'm saying this is where I want to own the shares at the $76 level. So now we're going to think about a few things. What are the outcomes of this trade? Because you always have to define your outcomes before you enter the position. So once we pick an expiration, we pick a strike price and everything, what happens next? Rocket Lab is going to do one of 2 things. It is either going to go up, it's going to go down. Actually, it's going to do 3 things, or it's just going to go sideways. So we have to be prepared for all 3 of these events to happen. So if we sell a cash secured put at 76 and Rocket Lab continues up over the course of the next week, we just keep that options premium and we never touch the shares. That's very important. If you expire out of the money, meaning above your strike price, you just keep the shares, you never touch them, but you keep the options premium. And the same thing is going to go for if we trade sideways. It's going to be the same thing because we're still trading above our strike price. We did not expire below it. We're just kind of chilling above it. And you can see that this price action right here is pretty sideways right now as I speak about this. But in a case like this, again, we did not expire in the money. We're out of the money. So we are just going to expire worthless. We're going to keep that options premium and we are not going to touch any shares. Now, in the case of Rocket Lab coming down and expiring below our strike price, you still keep that options premium. That is still, your thing. You still have that. You still get that. But now you own the shares at your level. So no matter what, if it expires here or if it expires here, you still own the shares at 76. So this is why you've got to pick your strike price very, very carefully, because at the $76 level is where you are locked in at your expiration. So it could dip 1% below 76 and expire there. That's where you own it. It could dip 10% below 76 and that's where you own this stock at now. So that's why your strike price is very, very important. So once we are prepared for all three outcomes, we know exactly what is going to happen. Only now do we go over to the options chain. All this technical analysis is just making sure the setup is in the right place for us. This has nothing to do with options premium yet. Premium is the last thing we look at. What I will say with my personal goals, I like to target about a 0.6% week on the low end, and on the high end, I'm looking for about 0.8%. And this is me running weekly options. So this means I do my option, I set them at the start of the week and they expire at the end of the week. So I'm really only in trades for about 5 days. And this is the healthy sweet spot that I like. And a big thing here is obviously setting your percent goals. So I like to kind of consider a monthly goal. So I like about a 3% gain. And if I'm continuously doing a 0.8% gain every single week, that's obviously getting me to just over 3% at the end of the month. So obviously some weeks are going to be higher, some weeks are going to be lower. So this is a good aim for me with variance where I'm able to say, well, maybe I can't achieve 0.8%. My, minimum's more 0.6%. Some weeks I just, lock in 0.5% because the setups don't fit. So it's one of those things where I never force any trades, and you guys need to get into the mindset of never forcing trades with this and not chasing premiums or percent goal. It's always premium comes last. This is why I'm showing you guys all the chart setup, completely first, all the technical aspects of this, because the last thing you want is to be stuck in a stock just because you chased a little bit of premium over the course of your trading over the month. So again, this is something you reverse engineer. So we're going to take a look at the options chain in 1 second, and then we'll, reassess, and I'll show you guys how this plays out. But another thing here is you want, from current price at the start of the week, this is very key, to your support level, you want at least a 5% discount. And you can see Rocket Lab actually fits the bill perfectly. This is just because this is me saying, you know what, if I'm going to pick up these shares, it has to be at a discount, because anyone that's buying in these levels right here, and if it drops 5%, they're immediately 5% in drawdown. But if you sell a cash grid, put 5 to 10% below where current price is at the start of the week, this means that you got a 5 to 10% discount on that stock, which is absolutely amazing. And this is why we sell it this way, where it's like we let the market come to us, we get paid to buy at a discount, or we get paid to not buy any shares at all. So this is my entire philosophy. So this makes sense. And again, we'll just recap really quickly: 10 to 15% off all-time highs, which is here. We have that. At least 5 to 10% off the most recent high, no problem, we're good with that. And at least 5% from current price to the strike price, we're good with that. So with all this being intact, now we have a safe position to say, all right, now it is time to head over to the options chain. So when you search up when you search up a ticker on Interactive Brokers, this is the brokerage that I use, and as you can see, it is a live account. This is where I do all my trading on. So I highly recommend. That's not even sponsored. I just love Interactive Brokers UI, especially for selling options. Now, what I will say is this is what you're going to be greeted if you use IBKR. When you search up the ticker, we're just going to head over to options. This is going to be the same for kind of whatever brokerage that you're actually using. But in this case, obviously, we're using IBKR because that is my personal brokerage that I use. So what I'm going to do here is I am going to switch to next week's expiration just because we only have 1 day left, so the premiums will not make sense for us. So in this case, I'm going to show you guys how I do it with weeklies. If you guys are a new trader, you don't have a lot of time allocation towards trading, I would highly recommend playing maybe the 2 weeks, so about 14 days expiration, to about a month, which is about 30 days expiration. So this lets you kind of take, less trades, less trade management. But for me, since I am a full-time trader, I like to do weeklies just because I can manage those positions week in, week out, and whatnot. So obviously I will say, so where was our level? 76. So let's find 76 on, all right, so minor technical difficulties on this. I didn't even realize that if you click into one of these, it actually shows my account number and account balance. So I'm not going to click into any of them. I'm just going to explain it as is. But what happens here is you can see these numbers right here. So we're looking to sell put. So this is going to be on this side. So what we're going to look at over here is actually how much we are getting, per put that we are selling. So in the case of 76 right here, you can see the bid and the ask. So if you were to put a position in the middle of the bid and the ask, you're looking at about, you can see the last price that was sold. So in a case like this, if you were selling at the 76 level, you're getting paid $1.56. This is per share. So obviously times 100 shares. And let me go back and actually explain that math to you guys super, super quickly. So remember, so one options contract is actually equal to 100 shares. You can only ever do this in blocks of 100 shares. And in this case, you guys have to remember this. So if you're trying to control one option at a $76 strike, it's actually going to be 76, because that's your strike price, times 100, because you're getting 100 shares. And this means that you need $7,600 to make this singular trade. So I will say, if your account size isn't that big, you're playing with some smaller stocks, you know, maybe they're not the ones that you would love to own long term, but this is why I always say, like, you have to manage your risk and always have cash set aside. I do this every single week, day in, day out, literally with no margin. Because I don't believe in using leverage. That at that point, you're using someone else's money. They can close that trade whenever they want, and that obviously does affect you. So be very cautious of this. So one options contract equals 100 shares. That goes for, you know, buying options, selling options, whatever that is. Obviously, 2 contracts is going to equal, you guys can probably guess, 200 shares. And then this amount would go up. So instead of 100 multiplied by 200, just, you know, double that number. So you're looking at about over $15,000 in capital required for that trade. But for the use case of this example, we're going to use the math of one contract on this specifically. So again, if we look at the $76 level, we would get paid about $1.56 per share, which essentially equates to just $156. That is, like, just move the decimal place over, quick maths. So you get $156 for making this trade for an 8-day expiration. So it's not technically 1 week, it's about 8 days. But if you actually extend that time out about 2 weeks, you can see at the $76, you make $279. Same level, just extending that over time. So you've doubled the amount of time. This is the cool part about options. You can kind of stretch stuff, you know, using time. Options decay is obviously a very big thing. I can do a whole other video on how I kind of like play that stuff, but you can see if I go to a month's period of time and find 76, that's $450. So obviously you have to do the math. If you're just more of like a weekly guy like me, you have to know how much you're getting per week, versus if you're just like, I don't really have time, I'd rather do weeklies or bi-weeklies cashier puts. You know, you're making more, you don't have to manage the trade as much, and you're kind of just locked into that for the month, and you just get this over a month's period of time, versus I'm a little bit more flexible when I'm doing weeklies. So I'm just able to, you know, go in and actually, you know, play this every single week, and then I can justify my premium gains over that course of time. So for this example, we're going to be using the weekly one, just because that's kind of like what I do. This is still like way more because it's 8 days, and I'm usually playing about 5 days. So take that with a grain of salt. This amount is going to be less, but you can see $76, 1.56, 1.74. So what we're going to be doing here, oh my gosh, the options chain keeps moving. But what we're going to do here is use this price for it. So you can see, we'll do the math again together. So one contract is equal to 100 shares, which means $76 strike price. That is a horrible 7. I am so sorry. But as you can see, our strike price is at 76. So $7,600 is what is required of us to make this trade. Now, in doing so, let's go back over, and you can see $76 strike, $1.56. We'll use the last, because this is what the last option was sold for. So 1.64. And all this means is that 1.64 times 100, because 100 shares is going to give you $164 collected for the week. So you're putting up $7,600 to make $164. Now, while the RR does not sound good on that, remember the 3 things that can happen. This could go up or sideways. You just keep that $164 for the week, never touch any shares, and move on. Now, in a case like this, like I said, I like targeting a 0.6% to about a 0.8% week. But what I can do here is if I just take $164 divided by 7,600 times 100, this is actually a 2.15. I need to get a mouse or something instead of using a trackpad. This is a 2% trade basically for 1 week of agreeing to own or agreeing to buy the shares. So let me put it to you like this. If this expires worthless, or just goes, if it just expires worthless because it went up or sideways, you made 2.15% on the week on that one trade for doing nothing. You never bought the shares or anything. Assuming it does come down and you get assigned the shares at 76, you still keep that $164, 2.15% on the trade, and you own a stock at a level that you do want. So I'll explain what happens if that actually does happen, and then I'll go through what happens at that point in time, because now we're still on the cash secured put side of things. So again, being very clear to you guys, you're getting paid to agree to enter trades, and if you don't have to enter the trade, you just keep the money. So this is how I'm rinsing about 0.6 to 20%. And I rarely get assigned per my strategy. I post all my trades for free on my Instagram every single week for transparency purposes, and you guys will see that I rarely ever get assigned shares. So I'm basically agreeing to buy shares every single week, week in, week out, and I never have to touch them in the first place. So that being said, we can move on from the cash secured put side of things and move over to the covered call side of things. So again, this is one of those things where if you're not getting assigned, you are just never touching the shares at all. And that's it. You really don't touch anything. That's it. You're all good. Everybody's happy when they're not getting assigned shares. But assignment is not the issue. And this is what I want to explain to you guys. So let me clear my drawings here real quick. And I'm going to show you what happens if you are assigned the shares. So in the use cases of these, this is what happens. Oh no, we fell below. And let's use the 72 level right here. Let's say Rocket Lab came all the way down to 72. What's going to happen here is what is next. So what happens here is we sold a cash secured put at 76 and we came all the way down to 72. So you've expired in the money, meaning you were given your 100 shares. So obviously that money that you made from the premiums, that $164, goes actually into your cost basis. So you actually own it lower than 76, which isn't too bad. So I'm just using this line here as where simulated price is going to be. So we change this from a cash secured put to where the shares are owned at, because this is technically where your cost basis is going to be, plus or minus a little bit from that options premium you got. So now from here to here, you are 5% in drawdown, but the trade does not end here. This is exactly where we go back here and we sell a covered call. So puts are on this side, calls are over here, at least for interactive brokers. So this is where you kind of decide, where do I want to exit the trade at? If you're a break-even guy, you're going to sell covered calls at your cost basis. But that's no fun, because I want to own this long term. So I want to pick a level that I can sell my shares at. So what I can do is, and remember, because we're selling this in hopes of saying, hey, I do want to own this long term. So I'm not just going to tag out extremely early. So what I'm going to do is use this resistance level as an area for us to just use as our TP. So say 89 is the level we want to exit at. I'm going to put another yellow line, or actually, let's just keep it as blue. We'll keep it as blue for now as the TP. This is where we want to go. This is where we are. This is where our shares are assigned at. This is where we want to go. Actually, for this example, guys, it's just because the premiums are going to reflect differently over here than, where price actually is, because price is already at 80. So what the premiums are going to be up here is way different from what they'd be down here. So what I'm going to do is, for this use case example, we're going to say we were assigned at the $76 level. And these shares are now going to be, say, in profit. So you got assigned down here and we're up. This is what we're going to do, because it's going to apply the same way if we're in drawdown or if we're in profit. So we say, look, we want to exit at the $89 level. So what I'm going to do here is I'm going to go find 89 on the chart here. And you can see 1.12, 1.25, the last option was sold for 1.28. So let's just do our math again. So we put up $7,600 to make this trade. We got assigned at 76. We got paid about $164 for agreeing to enter the trade. Now we want to exit the trade with a profit. So we're going to agree to sell at 89. Like I said, guys, you have to bear with me a little bit. There is variance here because we're sitting at 80. We're not sitting at 76. So if we're sitting at 76, this number is going to change very drastically. So I ask that you do, bear with me on that just a little bit, but we'll find 89 again. And we can see that it sold for 1.28, which means for when you sell a covered call, you are agreeing to sell the shares at an area, just like with a cash secured put. You agreed to buy the shares down here and you got paid for that agreement. With a covered call, you're just agreeing to sell the shares at an area of your choosing, which is going to be this $89 level. And in doing so, you get paid that options premium again. So paid to enter the trade right here, paid to exit the trade right there. So what's going to happen? You're going to sell your covered call. So now your covered call is locked in for a week. So in that week, what will happen is the market can go up, sideways, or down. So what happens in these three examples? If the market goes down, this option obviously loses its value and you keep this $128, but your share price is going to go into the negative. So your P&L is going to start doing this. But what we're going to do is, no matter how long we're in drawdown for, we're just going to keep selling covered calls all the way through this. Because once, and again, this is very, dependent on your stock selection being very good. Like I said, and I prefaced very strongly at the start of this video, because if you do not have a good stock, the stock is going to keep doing this. But assuming you've picked a good stock, good fundamentals and everything like that, eventually it's going to start doing this. And if your cost basis is right here, you're going to be break even eventually. But what have you done? You've used these shares to generate income the entire time you've been in this trade. So as it goes down, yes, your strike is farther away from your TP. So you can move where that covered call is every single week or 2 weeks that you're selling it to generate more premiums. But then you start coming back up. And this is where we say, okay, now we're getting closer. So the premiums start getting better. So now you can start selling covered calls again, where you want to exit the trade. Obviously, you only ever sell above your cost basis, just because if you sell a covered call down here and we jump back up and it expires here, now you're losing all this money in share gains, or this would be a loss actually, because you're selling a covered call below your cost basis. So I never suggest doing that unless there's you have done your own research and that's you really want to get out of the stock. But I will say, because once your P&L is done doing this and it comes back, you've been using income in the background by selling covered calls to do this in the background. So then by the time you get back to break even, you've used these shares to make a profit. So that's example one of can happen if you go into drawdown. Now, example two is going to be if we just went sideways. Say we just went sideways for the week and expired worthless. We didn't get to the level that you wanted. You're just going to sell another covered call, which means you make another agreement to buy the shares. You just find the level, do it again, and then you're just going to sell the covered call at that area again, get paid again, and that's it. And you're going to do this basically until you reach your TP level and expire there, because you guys have to remember, and I'm going to show you, from your cost basis for shares all the way to here is a 17% gain. So let's be very clear about this. Say in 1 week's time, somehow, in a perfect world, I'm going to show you guys right here. Hold on. What was that? That was 128. Ooh, let me put those back actually. So in 1 week's time, you come down and then you get assigned the shares at this level. And again, in the next week's time, you come up and you tag this level. This is obviously a dream case scenario. It's happened to me quite a few times, but this is, don't expect this to happen every single time. Came down, assigned, came up, and got your shares called away at this level. What happened here? So you made $164 to enter this trade. You made an agreement to sell the shares at that level and made $128. Now, again, let's measure out the percent gain from here. Hold on, there we go. It was about 17%, right? Let's just call it 70% to be a easy number here. So let's keep that there. So it's gonna be 7,600 times 0.17, which is gonna be, let me write it down for us, 1,292 in share gains. So now let's recap this trade specifically. You got paid to enter the trade. Let me even put it over here. You got paid, oh, not a line, whoops. You got paid to enter this trade, like I said, but with a cash secured put. And this was at this level you got assigned. So you got the shares, but you keep this money. Then you made a covered call agreement to sell the shares at that level, which gave you another $128. Now you have a 17% share gain from here, your cost basis, to where you sold it at, which is going to be basically $1,300. So just for argument's sake, I'm just going to use $1,300 plus the 164 plus this 128, and this gives us a whopping total of around $1,600 made on this trade. So what did we do here? We used a cash secured put saying I agree to buy 100 shares at this level if we drop there. We got paid. We got paid to be in this trade, and we got paid to exit it with a share gain along with our options premiums. So this is how you're using the shares to work for you. And again, like I said, I'm making this sound so easy, but there are so many examples of being in drawdown. I was down like 40% in drawdown on my IREN shares, and all I was doing was selling covered calls the whole way. And actually, specifically today, we saw profit for the first time, which is so cool. You can see this is where we bought it all the way down. I'm selling covered calls. We finally have recovered, came back up, making amazing support levels, came up to this area. We tagged off it. You can see where the share gain or the share cost basis is. We touched above it, which means we saw profit for the first time. And yeah, so assuming this company continues to do good things and come back above my cost basis, I've made over 10% in gains from just premiums on this trade while it's been in drawdown. So by the time it comes back up and I sell it at a profit, I've made probably the trade of the year for myself. So it is one of those things where you really have to pick stocks that you like, you know, that are fundamentally sound and you do want to own for the long term, because I would not have been able to survive 40% of drawdown if I did not believe in that stock long term. But recapping this, like I said, 10 to 15% off all-time highs, 5 to 10% off the most recent high, tapping into a key level of support, which is where we're going to be putting our strike price, or in between two levels of support, whatever you prefer. I like trading above the 200-day SMA for confirmation. If we're trading below it, I want to see some higher conviction in the fundamentals to make this trade happen. Again, when we sell a cash secured put, we get paid premium for making that trade. Just go over the options chain. You'll see how much you can do that with. You can play around on an options chain for free and just see how much money you would be making. We got paid for getting into the trade. We got paid while we were holding it by selling a covered call. And we got paid for obviously exiting through our share gains and that covered call expiring and calling those shares away. So there's obviously so many different examples I can give you. This is like the perfect use case example in a perfect world. So don't think this is all sunshine and roses. I literally just showed you the example of IREN literally assigning me here, dropping 40%, and then only coming back after a month. So trust me, this can get very messy. There's a lot of risk with this. You're, essentially picking up some premium gains with, the downside of infinite of, well, if you don't pick a good stock, this stock can legitimately just drop, like a rock and go down to zero if you don't pick the right one. So definitely something to be aware of. Again, like I keep saying, and I keep having to reiterate, none of this is, sunshine and roses completely. If you use the wrong stock for this, no strategy is saving you. But that's going to be a pretty comprehensive recap of my strategy. If you guys have any questions, definitely shoot me a DM, leave a comment in the comment section. I also post all this stuff on my story, on my Instagram story for free. And we have a Discord now, completely free as well. So definitely go join that if you're not in there. That's where you can ask me, as many questions as your heart desires. But make sure to leave a like and subscribe if you found value in this video, and I will see you guys in the next one.